All right, welcome to this explainer. Today we are putting Truist Financial through the ultimate valuation gauntlet using the exact frameworks of legendary investors. If you want to know what a stock is truly worth, you can't just look at a chart. You have to interrogate the underlying business using time-tested methodologies. So today we're putting on our expert analyst hats, taking all the freshly released Q2 2026 data for Truist Financial and running it straight through the unforgiving models of Warren Buffett, Peter Lynch, Benjamin Graham, and some strict quantitative discounted cash flow analysis. Let's see if this regional banking giant survives the gauntlet.
So, here's our roadmap for the gauntlet. We're going to kick things off with a company snapshot, then view the data through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, followed by some strict DCF and quant models before finally dropping our ultimate verdict.
Starting right off with Section 1, the company snapshot for Truist Financial.
Context really is everything when you're analyzing a bank, especially coming fresh off those 2026 Federal Reserve stress tests. Truist, which was born from that massive historic merger between BB&T and SunTrust, is an absolute heavyweight regional player dominating the southeastern U.S. But hey, size alone doesn't guarantee a great investment, right? We really need to look under the hood.
Right now, we are looking at a $64 billion bank trading at $52.50, paying out a pretty solid 3.96% dividend yield. It's a great baseline for us. And check out that price-to-earnings ratio, sitting at a modest 12.07. At first glance, this looks like a classic value setup. But is it a value trap or a hidden gem? Let's bring in the investing heavyweights to find out.
Moving to Section 2, the Warren Buffett lens, focusing on safety and moats.
So, Warren Buffett, the Oracle of Omaha, obsesses over economic moats, consistent earnings, and rock-solid management. And honestly, Truist breezes right through his qualitative checklist. They are targeting a return on tangible common equity, or ROTCE, of over 14%, which shows management knows how to actually turn capital into profit. Plus, their 10.9% CET1 ratio easily clears the Fed's hurdles, acting like a giant regulatory moat. Throw in a super seamless management transition from Bill Rogers to the incoming CEO Mike Lyons, and you've got exactly the kind of stability Buffett just craves.
But as we all know, Buffett is ruthlessly disciplined on price. If we assume an owner earnings proxy based on their nearly $2.9 billion year-to-date net income and historical cash flow yields, Buffett's intrinsic value lands right around $56, meaning at the current price of $52.50, it's just a hold. Why? Well, it completely misses his strict 20% margin of safety. For Buffett to actually pull the trigger, he'd want to see the stock drop down to around $44.80. Great business, sure, but not quite a great price for him yet.
Next up, Section 3, the Peter Lynch lens, looking at growth and categories.
Peter Lynch famously crushed it at the Magellan Fund by categorizing stocks and tailoring his expectations perfectly to fit them. So, his very first question would be, what exactly are we dealing with here? A fast grower, a turnaround, an asset play? Well, looking at Truist's 3.5 to 4% projected 2026 revenue growth, the answer is crystal clear.
Truist is a textbook stalwart, a big, steady dividend pair where the main things we want to check for are strong balance sheets and solid share buybacks. When Lynch buys a stalwart, he's not looking for 10x returns overnight. He wants downside protection and a steady drip of shareholder returns. And Truist absolutely delivers on this front with a massive $5 billion share repurchase target for 2026. On a $64 billion market cap, that buyback alone is a serious needle mover.
But here's the real clincher, the PEG ratio, which stands for price to earnings to growth. Truist's PEG ratio is sitting at 0.93. Now, in Peter Lynch's playbook, a PEG under 1.0 is basically the holy grail. It means you're paying less for a unit of earnings growth than the market average. Because that PEG is under 1, and because they are returning so much capital by buying back their own stock, Lynch would rate this a very solid buy. The slower growth is completely offset by the cheap valuation and massive capital return.
All right, on to Section 4, the Benjamin Graham lens, where we get into some deep value math. Now, let's strip away the narrative storytelling entirely and run Truist through the ruthless, purely mathematical gauntlet of Benjamin Graham, the literal father of value investing. Before he even attempts to calculate value, Graham demands a stock pass his defensive investor checklist, and Truist sweeps it easily. This proves it has the foundational stability a deep value investor demands. It's massively scaled, financially sound by Fed standards, pays a totally reliable dividend, and trades at reasonable multiples. it earns the right to be valued.
So let's crunch the numbers using Graham's legendary intrinsic value formula. We take the square root of a constant 22.5, multiply it by the annualized earnings per share, and then multiply that by the book value per share. We'll plug in the actual Q2 numbers. That's $2.34 for EPS and $48.04 for book value straight into this unforgiving equation. And the math spits out an intrinsic value of exactly $50.29. This is where Graham's notorious strictness really becomes apparent. At the current price of $52.50, we have absolutely zero margin of safety. In fact, it's trading at a slight premium to Graham's absolute intrinsic value. This results in a strict Graham sell or avoid rating. For a true deep value Graham investor to even touch this, they'd demand a 33% discount to this value, meaning the price would have to plummet below $34 a share.
Moving along to Section 5, DCF and Quantitative Alternative Valuations.
Leaving the historical legends behind, let's just let the pure quantitative models do the talking. We'll start by building our base case discounted cash flow. We're assuming a 5-year forecast period. We'll apply a 9% weighted average cost of capital, which is a pretty standard discount rate for a bank with this risk profile, and a 2% terminal growth rate to essentially mirror long-term U.S. GDP growth. When we discount their projected free cash flows back to today, our model hands us a fair value of $58.50 per share.
But, great analysts never rely on a single point estimate. This sensitivity table shows how that fair value shifts if we tweak our assumptions. And as you can see, unless growth completely stalls out to 1.5% while our cost of capital simultaneously spikes to a punishing 10%, the DCF model pretty much consistently sees Truist as undervalued in almost all reasonable scenarios.
Checking out some other valuation models, though, gives us a really fascinating split. The comparable forward PE, looking at peers in the regional banking sector, suggests an upside fair value of $58. However, the dividend discount model, assuming a 9% cost of equity and a conservative 4% dividend growth rate, drags the fair value all the way down to $41.60. So the models are essentially warning us the earnings might support a higher price, but the actual dividend payout stream on its own, maybe not.
Finally, Section 6, the ultimate investment verdict.
All right, we made it through the gauntlet. Here is our ultimate scorecard, synthesizing all these distinct methodologies into one place. Peter Lynch and the DCF model, they love the stock right now due to those buybacks and the low PEG ratio. Buffett likes the business itself, but he wants a cheaper price, landing on a hold. Meanwhile, Benjamin Graham's deep value skepticism slaps a hard sell rating on it because the raw asset math just doesn't offer that critical margin of safety.
So what does this actually mean for your portfolio? Well, the huge takeaways from our analysis highlight robust capital returns. A $5 billion buyback and targeting over 14% ROCE, those are major strengths. This company is undeniably shareholder-friendly, but you have to weigh that against the undeniable fact that deep value investors simply won't find a margin of safety here. Plus, there's always the looming risk of Fed policy impacts in such a heavily regulated macro environment.
So, blending all of these expert insights together, our final verdict is a solid hold. Look, Truist is a very good, structurally sound bank, but at $52.50, it is fairly priced, not vastly underpriced. But I want to leave you with this provocative thought as we wrap up this explainer. In a modern banking industry so incredibly constrained by rigid Federal Reserve stress tests, will reliable stalwarts like Truist eventually be forced by regulators to permanently prioritize safety and capital buffers over market-beating growth? And if so, are the days of bank stocks acting as growth engines officially over, making way for the era of the pure dividend stalwart? Let me know what you think.